Okay, welcome. My name is Kyle, and this is going to be an e-tutorial on how to solve problem S15-10 from the Pearson textbook. So there's Island Corp, and they issued 400,000 7% 10-year bonds at a price of 106 on January 1st, 2020. And what we need to do is journalize the following transactions for Island Corporation, include an explanation, and then it tells us that they use the straight line method to amortize the bond premium. And then part A is the issuance of the bond. So that's the first journal entry we're going to need to do. Okay, so even before I do the journal entries or even start thinking about it, I think this is probably a good opportunity for us to review some key bond related terminology. So here we have 400,000. That's the face value of the bond, 400,000. This is how much the lenders, the bondholders, are going to receive from the corporation at the end of the term of the bond. So remember, the bondholder, we can think of a bond just like a big IOU. The corporation receives money from a lender. So the corporation is the borrower, and the person that lent them the money is the bondholder or the lender. So the face value is the amount that the corporation, the borrower, is going to pay to the lender at the end of the term. That's the face value. This is sometimes called the maturity value or the principal value. It all means the same thing. And then what we have next is 7%. So this is what's referred to as the stated rate, the contract rate, or the coupon rate. 7%. And it's always stated annually. So what we'll see with bonds, and what's true in this example, is bonds are usually paid interest on a semi-annual basis, but the coupon rate, the contract rate, and the stated rate, they all mean the same thing, is always given in an annual term. Excuse me. So to calculate the interest payment on this bond, it would be the coupon rate, 7%, multiplied by the face value. This is going to dictate the interest payment on the bond. And then what we have next, and I'll just try and talk as I erase, is it says it's a 10-year bond payable. So the 10 years here is indicating the term of the bond. So 10 years. So if we think about this, I know that interest is paid semi-annually, and it's a 10-year bond payable. So there's going to be 20 interest payments in total because it's going to be paid 2 times per year times 10 years equals 20 payments. And then lastly, there's a price of 106. So bond prices are always expressed as a percentage of the face value. So if the price is 106 and face value is $400,000, the overall issue price of this bond is going to be that multiplied together, and that's math that's far beyond the capacity of my brain. So I'm going to do 400,000 multiplied by 106 is 424,000 is the issue price of the bond. But this is a good opportunity for us also to review what we know about bonds and why bonds, in this case, would be issued at a premium, or if the percentage was less than 100, that would be an issue at a discount, why that would happen. Well, we know there's an inverse relationship between bond prices and interest rates. And I'm not talking about the coupon rate, I'm talking about the market interest rate. So when interest rates decrease, bond prices increase. So that's what I mean by an inverse relationship. When interest rates go down, bond prices go up. Alternatively, if interest rates go up, bond prices go down. Again, this is referring to the market interest rate. The coupon rate that's stated in the question, and it will be stated in the contract of the bond, it doesn't change. What changes is the market interest rate, and the market interest rate influences bond prices. Maybe this is a good opportunity for me to explain why. And to do that, and I know I'm taking a little bit of a long intro to get to actually solving this problem, so my apologies. Just fast forward if you know all of this stuff. But let's consider two companies. They're the same size and they have the same risk exposure. They're identical in every facet, and it's company A and company B. Both are going to issue a bond that has a face value of $1,000. The coupon rate for company A, though, is 5%. The company rate, or the coupon rate for company B, is 6%. And let's assume the market interest rate, I'm going to call it MR, is 6%. And of course, they're going to have equivalent terms on this. So I'm just going to say the 5-year term. So all of these variables, the face value, the coupon rate, and the term are fixed in the contract. They can't change. What we're going to see here is there's no investor that would be willing to purchase companies A bonds. Why? Because they're paying a lower coupon rate. So everybody would flock, all investors would flock and buy company B bonds because the interest rate is higher. It matches what the market interest rate is. Nobody would buy company A bonds because the market interest rate is 6% and they could just go to the market and get a higher interest rate. So what company A is then forced to do is lower the price of the bond in order to sell their bond. They have to lower the price of the bond so that the bond price multiplied by the coupon rate would then yield the 6% market rate. So that's a little bit of background about why bond prices fluctuate with market rates. But it's important to remember the face value and the coupon rate don't change. What changes is the bond price and the market rate. So then going back to S15-10 and thinking about this, well, why do organizations issue bonds in the first place? They issue bonds to raise money. It's a vehicle for which they can raise cash and use that to really do whatever they want with it. Usually it would be for a specific purpose, but it's a mechanism that allows them in order to raise cash. So I know when an organization issues bonds, cash is going to go up. I also know that bonds are like giant IOUs. There's a lender that lends the organization money, and that organization is the borrower, and they have to pay that money back at a certain time in the future. Since they have to pay that money back, it's a liability for them. So liabilities are going to increase as well. So I know cash is going to go up because they physically have more cash. They have to pay that cash back at a time in the future to their lender, so liabilities go up. Now, this is going to be true. These are going to be the only two accounts if the bond was issued at par. In this case, in this problem, we know it's issued at a premium. So to start this problem, I know cash is going up, and to calculate how much cash is going up by, it's simply going to be the face value, the 400,000, multiplied by 106. And that's math that I can't do, so it's going to be 400,000 06, and that's $424,000. So that's going to be the debit to cash, and I'm debiting cash because cash is an asset. And to increase assets, I debit an asset. So 424,000. That's how much cash for this company is going up by on January 1st. Now I know they have to pay back the face value at the end of the term to the bondholders, right? And the face value doesn't change. So I'm going to have a bond payable liability, and I know the face value is 400,000. So that's going to be my debit, or my credit, sorry. To increase the liability, I credit liabilities. But my journal entry here doesn't balance. I have 24,000 greater debits than I do credits. The difference here is going to be a credit to what's called this premium or bond payable premium or premium on bond payable. And that's going to be $24,000. So this is actually a liability account, this premium on bond payable. Why? Well, these two together make up what the market value of that bond is as of January 1st. So inclusive of the market interest rate, this is the market value of the bond. If this organization wanted to liquidate this bond immediately, which means that they want to no longer have this as a liability on their balance sheet, they pay off those bondholders, and they wanted to do it right now, well, they would likely have to pay a penalty in order to do that. But ignoring a penalty, they would have to pay back all of this because that's the market rate investors are demanding as of January 1st. So this is part A. We're done. We issued the bond. This is the journal entry for the issuance of the bond. Now it's 6 months later, and we're doing the first interest payment. So I know the coupon rate is 7%, and I know that interest payment is calculated by multiplying it against the face value of the bond. And I also know interest payments are semi-annual. So I have to prorate this to 6 months of the year. And again, that's math that I can't do in my head, so I'm going to use Excel. And this is 14,000. So what does this 14,000 mean? Well, if this bond was issued at par, this would be the interest expense, 14,000. This bond wasn't issued at par, though. This bond was issued at a premium. And I'm going to need some space here to work with, so I'm going to just remember 14,000. I'm going to write it over here. This bond was issued at a premium. And if I pull up, or if I write down my inverse relationship again, when interest rates go down, bond prices go up. This is what's called issuing a bond at a premium. Just like in this problem, the bond price increased from 400,000 to 424,000. Well, interest rates go down, and we just calculated the interest if it was at par. But this wasn't at par, this was at a premium, so you would think our interest expense is going to be lower, and that's true, it is. Our interest expense is going to be lower by an amortization of this bond premium that we identified in part A. Our cash, yes, is going to go down by 14,000, so I can start my journal entry with that if I want to. Cash is going to decrease by 14,000. But what we actually do is we take the premium on bond payable, 24,000, and we amortize that over the term of the bond. It told us in the question they use a straight line method, so this is fairly simple for us. It's just 24,000 divided by, it was 10-year bond, but interest is paid semi-annually, so that's 2 times per year. So 24,000 divided by 20 is going to equal something, and my brain is too small to do that math, so I'm going to use Excel. $1,200. So I'm going to amortize the premium on bond payable over the term of the bond by this amount. So I'm going to lower the liability with each interest payment. 1,200. So I take this and I add it there. Which means that the interest expense to this organization is going to be the 14,000 in cash that they're paying less the premium on bond payable. So $12,800. So what we see is when bond prices go up, the interest rate or the interest expense for the corporation goes down. So our relationship is true. When interest rates go down, bond prices go up. So in effect, the effective interest rate here is actually much lower for this organization because they just, collected the cash up front and then they amortize that over the life of the bond to lower their interest rate or their interest expense, sorry. So then what we do is we're done with part B, and I'm going to just clear this markup, and we're done with this problem. So again, this was a tutorial on how to solve S15-10 from the Pearson textbook. If you have any questions, feel free to reach out to me or any of your instructors. Otherwise, I hope you found this helpful. My name is Kyle. Have a great day.